Hey, good morning, everybody. My name is Van Dang. Today's event is home buying event, so I want to welcome everybody to that. Uh, so if you're here, you're probably more than likely, I want to buy a house, but now what? You don't know what to do. So after today, we're going to make sure you know where to start at. We're going to make sure you have a better idea of the home buying process, and you're going to understand what funding options you might be qualified for. So before I get started, I'm gonna go down some housekeeping rules, to-dos, make sure everybody's good to go. First and foremost, the best type of teacher is very interactive. Bill Gates says that, and we wanna make sure you all are actually applying that throughout this whole event. So you should have a little bar at the bottom of your screen or your mobile device, and there's a little mute button. So throughout the whole event today, whether myself speaking, I'm just be moderating pretty much, and then there's Talithia as well as Lee. If you all have questions, feel free to unmute yourself. This is a very informal session. We'll make sure everybody is very get the most information and have the most best experience possible. There's also a camera button. So if you feel like you want to make sure you show everybody your beautiful faces, by all means, show your faces. Um, Also, there's a little chat box, so feel free to hit the chat box. This little thing comes up, write in the chat box, and we'll make sure that you're good to go and you can write in there. So if you're too shy to unmute yourselves and talk, just write in the little chat box here, and we'll make sure you guys are good to go. So I'm gonna go down the list here, and if I mispronounce your name, please correct me. So we have is it Krista?
Yes.
Okay, how are you today?
Good. How are you?
I'm good. Thank you for asking. So can you see my screen?
Yes.
Awesome, awesome. Okay, thank you. Alrighty, next person on the bat here. I'm sorry if I say your name correct. Is it Akuba?
Aquavia.
Aquavia. Okay, how are you today?
I'm well, thank you.
Cool, cool, cool. Can you see my screen?
Yes, I'm able to see your screen.
Awesome, thank you. Hey, Clayton, how are you doing?
Good, man.
Cool.
Good, man. How you doing? All right.
Good,
All right.
good.
Sorry I was a little late.
No worries. You're actually on time.
All right. All right.
All right. You can see the screen?
Yep. Oh, yeah. Crystal clear.
All right. Thank you. Alrighty. Morning, Ethan. Morning, Kayla. How are you both doing?
Doing well, thank you.
Cool. You both can see the screen?
Yes, sir.
Yes.
Thank you. Kiara, is that how you say your name?
It's Kira.
Kira. Okay, Kira. Welcome. You can see my screen?
Yes.
Awesome. Thank you. Hi, good morning, Lauren.
Hi, good morning. I
How are
can see you.
you?
I'm
Awesome.
good. Thank you.
Thank you. Okay, I can't unscreen you guys here. So we have, is it Jean and Wilfredo? Janine?
Janae and Wilfredo.
Okay. Okay, cool. All right. You guys can see the screen?
Yes.
All right, thank you. I'm sorry, you guys are in my study group. I can't say your name. Is it Hina or McCann? All right. Anyways, we'll get started. If you guys can't hear me or the screen flickers and you know what's going on, just let us know. Thank you so much for participating in the when we like to purchase. We want to have a better idea of when you guys like to purchase. That way we can guide the conversations. So again, I'm going to get started. So let's meet your host today. Your host, first person up is Talithia Morris. She is a licensed real estate agent for eXp Realty. She's licensed in Virginia and Maryland. We also got Lee Fry. She's a senior vice president for George Mason Mortgage. So these two ladies will go over the home buying process today. If it's your first time, definitely pay attention, take notes, because they're gonna give you guys a lot of like useful information, and maybe you all are eligible for some free money you didn't know about. So I'm gonna get started here. I'll make sure my camera works over here. So Talithia, is your camera working? Okay, all right. Cool. I'm gonna pass it over to Talithia Morris. She's gonna introduce herself and let you guys know who she is.
All right. Hey, good morning, everybody. So, like Van said, my name is Talithia Morris, and I am a licensed realtor in Virginia and Maryland. I think, well, this month makes 3 years that I've been a realtor. So, I actually purchased my first house like seems like many years ago now. But I was 21 at the time, and then I sold that house like 2.5 years later and purchased another house. And each time I worked with a different realtor and had a different experience. However, they did a good job overall, but there were just some things that I wish I had known or that they could have helped guide me with along the process. So uh, hence why I try to do these events and also coordinate with lenders, see kind of what programs are out there available for people whenever you are doing your first purchase, because I mean, who doesn't like free money, right? And then also just educating myself a little bit more on the lending side as well. I'm not a lender, however, just knowing more of the basics with that side so I can better help guide my clients. So we're going to start with squashing some of the myths and fears about purchasing a home. And so let's see, the first, sorry, my click. Okay. So I don't know if many of you heard this, but a lot of people ask me, they're like, don't I need like $20,000 to buy a house? Or, and I don't know where this figure came from, but I will say that of all the clients I've worked with, the most one of my clients needed, unless you intentionally wanted to put down a significant amount of money on your home. Like I've had clients that I work with selling their house, their previous house, they have equity from that house and they want to put a large down payment down, like 50,000, 100,000 or something like that. But aside from that, if you're purchasing your first home, the most any of my clients have ever spent out of pocket has been about 12,000. But that it just depends on what kind of market we're in, like if it's a seller's market or buyer's market and there's multiple offers on that house. But I would say on average, most people, I always tell people to have at least like 5,000 or 6,000, but I've had clients that came out of pocket only $2,000 to buy their first house. And then sometimes if you're a VA, if you have a VA loan, sometimes you can get actually that money back at the closing table, just depending on how we structure the offer. The other thing I hear sometimes, some people feel like they're going to be locked and trapped in that house forever, like they have to live there forever. And actually, somebody just mentioned this to me like a week ago. She's like, yeah, I want to make sure I know everything before the 30-year commitment. And it's just like, what 30? I mean, I guess marriage, but other than that, I don't know of a 30-year commitment you have to do. So you have options once you purchase that house. And I always recommend for people that if you're going to be in the area for at least 2 years, I think it's worth looking into purchasing versus renting. And then, but if you're only going to be in the area for a year and you know that for sure, then, I would say probably rent. However, just always looking to see which is going to be a better situation for yourself. So you need a perfect credit score. First of all, I've had several of my clients, they have, really good credit scores. However, up until COVID-19 hit, you could actually buy a house with a 580 credit score. And I don't think a lot of people knew that, but yeah, that was an option for you. But now, since COVID-19 hit, the guidelines have become a little bit more restrictive. And so now, and Lee's going to talk about this a little bit later, but now you're probably looking at having at least a 640 credit score to qualify for some of the grant programs there and to qualify for a loan in general. And then what I was going to say, let me add this about the credit score. So a lot of people use Credit Karma to monitor their credit score. And that's like, it's not the worst thing, but it's kind of close to the worst thing you could do. They really don't provide accurate details about your score. I always tell people like, it's okay to use the free app for monitoring what reporting on your credit. However, when it comes to scores, they have a lender has a different algorithm they're going to use to determine what your FICO score is, and Credit Karma also only shows you it only shows you 2 of the 3 credit bureaus. And I still to this date, I haven't had anybody that once they put an application in that their credit scores even remotely came close to what the lender had. I've had some clients that put it in and their scores like 50 points higher, but I've also had some where 50 points lower. So you just never know, but don't use them as a reference for like what your actual credit score is. All right. And so a lot of people, I guess they're fearful of if something happens in my house, like I'm solely responsible for it. And I mean, you are responsible for it. However, there are certain things that are in place for you to have coverage for certain incidents that may happen once you're a homeowner. So one is a home warranty. Whenever you purchase a house, you're going to have a home warranty, and this covers your HVAC unit for your heating and cooling system, your appliances, and sometimes certain pipes and leaks that may occur. I've had a client, she actually, it was crazy. Like the week after she moved in, there was a leak from the shower down into the kitchen, but she called the home warranty company and they came out and fixed it. And it's just a service fee, like $75, something like that. And then same thing with like your HVAC unit or appliances. Like if they can't fix it, they will replace it for you. So those things are covered once you're coming to your new home. Now that's for 1 year, but you can always extend it. But the problem is sometimes people will cancel it and then they try to restart it back up. And then that makes it a pre-existing condition at that point. So I had one client, she canceled it after we had got it for her when she purchased. And then let's see, maybe a couple months later, she had an issue with her ice maker or something. And I was like, oh, we'll call the home warranty company. And she's like, oh, I canceled it to get the money back. And I'm like, all right, so now you now you just don't have ice. You gotta go to the store. So just keep that in mind. You have that coverage for your appliances. And then you also have what's homeowners insurance. So this is for any type of exterior damage that maybe caused your house from like storms and so forth, or, you know, you might have a leak in your roof. I mean, this stuff doesn't normally happen to people, but it can occur. And I know when I bought my first house, I learned about the home warranty. I needed like literally every penny I had to go towards my expenses to purchase. So I didn't have a home warranty and my HVAC unit didn't work. So it ended up costing me, a decent amount of money. But if I had the home warranty, then I would have been covered with just a service fee basically. And so with the homeowners insurance, you're required to have homeowners insurance, just like some tenants, you're required to have renters insurance. But homeowners insurance is for coverage in the event something does happen. Like I had my basement flood in my second house, and I called my homeowners insurance and they sent ServPro out, and they also they had to like tear down everything in my basement pretty much, like 90% of it, and then the adjuster had to come out and everything. But I paid basically a deductible for that, and they actually, the insurance I had, they took the deductible out of the money they were giving me. So that was pretty nice versus having to pay it outside of the money they were giving me. So it's kind of similar to if you put a claim in for your car, if you have like hail damage or something like that. So those things are in place that you're not, now if it's something cosmetic in your house that you have to do, obviously you're gonna have to come out of pocket yourself for that. However, for the big ticket items, if something were to happen to those things, there are certain things in place to have coverage. So you're not like thinking, oh, I'm gonna need $10,000 to set aside in case this goes bad or it stops working or something. Okay, so I just want to cover some of the benefits to home ownership. Like when you rent, you can't write the interest off. So as opposed to when you own. So whenever you purchase a house, whenever you're making your payments, some of that payment is interest. And you at the end of the year, you're sent a form. I forgot the name of the form, but basically it shows you how much interest you paid that year, and you're able to write that interest off with your taxes. So that's one, great benefit. And you also get the opportunity to build equity. So if you were down the line to sell or do a cash out refinance, there's plenty of options. Then you can extract equity from your home in the form of cash. So the that's another benefit. And then you're possibly looking at paying equal or less than what you would pay to rent. So I actually have a client right now where um, she is under contract, and there's a house that is maybe like less than a mile away, a little bit smaller, but that rented for 1,800. But now she's in a position where she's going to have this mortgage that's only going to be 1,700, and she's going to also be able to write off the interest as well. So there's certainly, like, you just have to weigh it out for yourself. And then I've also just done a lease recently for somebody, and the lease, you have to put how much you're going to pay over the like term. And so it adds up pretty quick, and then it's just wasting money every month. So you're helping your landlord pay their mortgage basically on that property, versus being able to invest in your own. And ownership and legacy. So a lot of people don't think about this because, I mean, when you're younger, especially, I had somebody that she's going to be purchasing towards the end of this year, and she actually, so her both of her parents passed away last year, and she has 3 sons, and she's just like, whenever her parents passed away, they had nothing like to their name basically. So they always rented, and they had no property or ownership to pass down to her or her siblings. And she's just like, if something happens to me, I want to be able to leave something to my children. So I'm definitely going to be purchasing, this year for sure. And so she just wanted to have some type of foundation set up for if something, in the event something were to happen to her, for to leave to her children, because she experienced that on the other end where she didn't have that from her parents. And it's just sometimes you don't think about it. I mean, because I mean, we like to live forever. However, this is a reality of it. All right, so we're going to cover the costs that are involved whenever you purchase a home. So the first thing you're going to have is I'll talk about this a little bit more whenever we do the process to purchase. But you're going to have a home inspection done once we have a contract on a property that you find to be your home. So on average, they're about $350 to $550, depends on if you're buying a condo, townhouse, or single family home. And the home inspector is going to go through and basically just look at the structure of the home, make sure everything is functioning properly as intended. And that way, you're more familiar with the home you're purchasing. And then he's also going to, and he or she, I haven't really met a female inspector, but I mean, I'm sure they're out there. So they're going to cover the information with you about the home, far as letting you know the life expectancy of your HVAC unit, your hot water heater, your roof, what condition those items are in. So, going into it, hey, do I need a budget in the next 3 years to buy a new HVAC system? Or, hey, this one's brand new, I probably should be, covered. And again, you'll have the home warranty for some of those things, but it's just to have you more familiar with the home you're going to be purchasing, and how often you need to service certain items in your home. Then you're going to have what's called an appraisal. So the appraiser is a third party that is sent out by the lender, and they are going to be assessing the value of the home. So this cost is normally roughly around this amount, $550 to $650, and it is paid prior to you purchasing the home. So those are kind of your out-of-pocket expenses.
Hey, Talithia, so we have a question coming in from the Facebook group here.
Sure.
So why don't you get some water while I ask this question? So the question is, the cost involved to purchase a home. You're showing us cost for home inspections at this rate, appraisals at this rate, and you're about to go over earnest money deposit. Is this amount right here, these totals or these costs negotiable when I'm buying a home?
So they're not really negotiable unless you can elect not to do one, or you can try to find a home inspector that charges less, but just keep in mind you get what you pay for. I've come across, not for my clients, but on the other end of the spectrum, whoever's representing the other party, that every home inspector that's has a license is not, the best. So you can try to negotiate that cost. However, that's on average what I've seen from a condo to a single family home, the amount that the home inspector that's really thorough that I know. Now the appraisal, that's not negotiable. The appraisal has to be paid for. Now, and Lee can talk about this a little later. Some of my clients, depending on, we're going to cover closing costs as well that are needed to purchase a home. And sometimes, depending on how much the seller has agreed to pay for in the closing costs, she's able to credit you back this money at the end of settlement if there's enough funds in there that the seller's agreeing to pay to cover the appraisal costs, because it's part of your closing costs, but it's something that has to be paid prior to closing. And I usually, I kind of stopped telling people that, because I just tell them there's an appraisal fee, because I had one person, and it was one person out of like over 50 clients, but she mixed up what I said, and she was like, well, you told me the appraisal was this, and it was with the home inspection and blah, blah. So anyways, just to not confuse people, I always tell people to like expect to pay that up front so they're aware. So it outright, it can't be negotiated with the appraisal being done, but you could potentially have it covered if there's enough closing costs that the seller is going to pay for you whenever you purchase your home. So I hope that
They put a thumbs up, so thank you for that.
All right, cool. All right, so the earnest money deposit, now it's somewhat negotiable, but standard rule of thumb is normally it's 1% of the sales price is what you're going to put down as your earnest money deposit. Now this is a basically a good faith deposit, and you're saying that you truly intend to purchase this home and you're serious about purchasing the house. So if you choose to do a $500 earnest money deposit, somebody else that's willing to put down $3,000 on a $300,000 house may have a better chance of getting that contract one from the seller versus you putting $500 down. So I've had some clients where I've put $1,500 and it may work, but it just really, usually it's 1%, or I can get away with like doing 1,000 less than the 1% or something. But you want to make sure it looks strong and that you're serious about purchasing a home. So what the earnest money deposit does on the other end is basically, in the event you default on the loan, not default on the loan, if you're in default with any type of contract contingency that we have, the seller could keep your earnest money deposit. Now, I actually have that going on right now for one of my flip properties. Some of you all, if you know me, I'm an investor, so I flip properties. And basically, I've extended this contract twice now, but I can't keep the house held up this long now. So I had to put it back on the market, and they are past their financing contingency. So I potentially could request to keep their earnest money deposit. Now we have to go through litigation and stuff like that, but I do have that option on my end right now to do that. Now, another thing that occurred to me one time happened was I had a client, and I don't know what happened, but she just told me, she's like, I don't want the house anymore. And I'm like, okay, this isn't not like a car or a credit card. Like, you can't just be like, hey, I don't want this no more. So I was trying to, representing my client, I was trying to find out the best way to have her covered so that she didn't, but I told her that, you potentially could lose your earnest money deposit. So I, I was trying to make sure she was covered in the event we were going to walk from that contract. However, there are certain contingency periods in place, and one of them is your home inspection. So once you do your home inspection, if you're no longer comfortable with purchasing the house, then you can void the contract and you just forego your home inspection fee, but you get your earnest money deposit back. So it's all about like our contingency periods and so forth.
Is that a question?
No.
Okay. So go ahead and get some water. So the question Ethan got is, if you put $500 down and someone else puts down more, do you get the $500 back for the earnest money deposits?
Oh, okay. So to answer your question, Ethan, you're only, so the earnest money deposit is going to be held by a third party, it's a title company, and they're only going to, the contract states, normally I put in there 5 days. So basically 5 days after we have a ratified contract, that is when you are responsible for getting the earnest money deposit to the title company to hold until settlement. So it's not taken immediately whenever you submit your offer. Now, the other thing I need to add about that is the earnest money deposit doesn't just disappear. So if you have a down payment you're responsible for, or you have closing costs that you're going to have to pay towards, that money is applied there. So it doesn't just disappear from your account, basically. Does that answer your question? Okay. All right, so let's talk about the closing costs. Now, whenever you purchase a house, there are closing costs associated with that loan. So you have lender fees in there, you have title fees, and they're going to be starting your escrow account, which is going to have your taxes and homeowners insurance in it, and they have to cushion that account for starting your mortgage payments. Now, on average, it's usually another 2.5% to 3% of the sales price, but it can vary depending on how much the purchase price is. But we kind of just measure it this way a little bit. But if your house is 200,000, it may be a little bit more, maybe like 3.5% or something like that. But on average, this is kind of like how we gauge roughly what your closing cost is going to equate to. Now, normally in a buyer's market, we can get the seller, in a buyer's market is usually like the fall and winter time. We can normally get the seller to pay the closing cost. But in the summertime and springtime, sometimes you're going to have to pay the closing costs, or you can bump the loan amount up if your ratios allow it. And Leah talk about the ratios, but they have to be covered somewhere by somebody. So normally, in most cases, we can get away with the seller paying half, but in a competitive market, you have to determine like if you're willing to go higher to have it covered by the seller and so forth. So that is another cost. And again, like I said, the earnest money deposit can apply towards that if you have to bring money to the closing table.
So Talithia, we had a question from the Facebook group here. This water. So Rachel asked, I have State Farm insurance. I have my auto insurance and my renter's insurance. if I was to go purchase a house, would I be able to have the insurance paid for through this closing costs through escrow, or is it better just if I use it through my regular insurance agent right now?
They can give you a bundle package deal. However, your home insurance, the actual mortgage loan, you're just gonna pay one mortgage payment, but your homeowner's insurance is gonna be factored in there to where you're paying a monthly amount towards that premium that you have for the year.
She put smiley face or the care logo. Care
Oh,
emoji.
okay. The care one, it's getting it's getting on my nerves a little bit because I'm used to the laugh. I mean, I think the laughing emoji to be the third one, and then now that care one's there, and I'm accidentally hitting it, and I don't know how I feel about it yet.
She put IKR.
All right. So everybody good with this part? Where all the monies, that's all the money talk, about the purchase. So we're going to talk about, we're just going to cover how your mortgage is broken down. So this will probably provide more clarity too. So you have your mortgage payment. And so in that mortgage payment, you're going to have your principal and interest and your taxes and homeowners insurance. Now the taxes are going to be based on the property you select. So if you're looking in Fredericksburg, Richmond, or if you're looking in Alexandria or Arlington, your property taxes are going to be different depending on where you're going to purchase your house. So that's going to be factored into how much your mortgage payments is going to be also. So just keep that in mind. The property taxes, like the further north you go, the more you're paying in property taxes. So your homeowner's insurance, both of these are going to be like annual amounts, but they're going to be divided by 12 and broken down into what your monthly cost is for your mortgage. So you have your principal and interest, and then you have your taxes and insurance, and that's going to make up your mortgage payment. Now, if you're using one of the government-backed loans, or if you're using even a conventional loan, however, you're not putting down 20% up front, you will have something called PMI, which is premium mortgage insurance. And it's going to depend on, like I said, the type of loan you have. So basically, in the event you default on this loan, they've already collected money from you up front, and it's basically paying something out because you're not putting down that 20% that is technically needed for a conventional loan to avoid paying it. So in VA loans, you don't have to worry about that. But for FHA loans and any loans with the grant program, you're usually going to have premium mortgage insurance, and it's a percentage that is calculated by, but it's not too crazy, the amount. But and then if you have a conventional loan with PMI, though, once you get to 79% equity in your house, that falls off. So that's a good thing about the conventional loan. So that could be done through your house appraising higher, or your mortgage payment. Every month you make it the payment, you're getting more equity in your house. So between those things, you can potentially have it fall off sooner than what it's scheduled to do in the amortization schedule.
So Talithia, a question from the Facebook group. Here's some water. So Terrence he apologized if this question is too long. It might not pertain to you, it might pertain to Lee, which is to the actual lending part. But the question he reads is, regarding PMI, if I get better rates after I sign for my property, can I refinance to get rid of this PMI?
If you get, repeat it.
So the question is, regarding PMI, the premium mortgage insurance, is there a way, if he heard that if he refinances,
Mhm.
that it can take off the PPMI.
Oh, it depends. So that's what I was saying about the appraisal. So if you refinance, you're gonna have to, and you're trying to get the premium mortgage insurance off, then they're gonna have to do an appraisal. So it could be done through that way, or once you have reached that amount and equity at the 79% mark, then you can contact the lender, whoever your loan servicer is at the time, and notify them. But they're supposed to take it off, but like how proactive are they with doing that? Who knows? So you would reach out to them and do it. Now you can do it through refinance, but it's just going to depend on how much equity you end up having in your house to determine whether or not the premium mortgage insurance doesn't have to be included.
He says, thanks. He'll have more questions later.
Okay, that's fine. Questions are good. That means you're paying attention. All right.
Oh,
There's a question?
no, go. Does it go?
Yeah, this thing keeps popping up. Sorry. Okay. All right, so we're going to cover the process of purchasing a house. So the first thing you're going to do is you're going to get pre-qualified. So that is done through the mortgage lender, and they're going to determine basically based on your debt to income ratio, your credit score, your income, your debts, all that stuff, to determine how much you're going to be pre-qualified for to purchase a home, and based on what area you want to live in. Like I said, if you're going to be purchasing a house in Springfield, Virginia, that's going to look a lot different than you purchasing a house in Richmond, Virginia. So those type of things matter as well. And then also, if you're purchasing a condo versus a townhouse or a single family home. Now you have condo fees if you're purchasing a condo, and you have HOA fees if you're purchasing a townhouse. And sometimes with single family homes, the newer ones, you have an HOA fee as well. Those aren't factored into your mortgage payment. However, it's factored into your debt to income ratio. So I've had some people reach out to me recently. They had a pre-qualification for, let's say, 250,000. However, if you're looking at a condo with 250,000, you're not going to be pre-approved for the same amount. So most of the time, on average, condo fees are about, I don't know, I've seen them like as low as 200, but on average, maybe about $300. And then you have some crazy ones that are like almost the same as another mortgage paying another mortgage payment. So it's going to vary. However, whenever the lender does your pre-qualification, they're going to do a loan estimate sheet, and they're going to have in their estimated figures for how much your property taxes are going to be for that area, how much your condo fee is going to be for that area, or your HOA fees. So they have something factored in there already to determine what your pre-qualification amount is. So what I do is all the time, normally when I'm working with Lee, I will, if we're looking at a specific property and I know that your debt to income ratio may be a little tight, and so it's going to really boil down to how much the HOA fee is, how much the taxes are, and the purchase price, then, and we don't really have much wiggle room, then I'm going to send the listing to her and tell her, hey, this is the taxes, this is the insurance. This is the taxes amount, this is the condo fee amount, and the purchase price, to see if those numbers are going to work for you to be qualified for that house. Now, I also, with the loan estimate sheet she sends over to me, we can kind of plug in the numbers ourselves to see if that's going to work for that particular place. So there's a lot of things that go into the pre-qualification. So you just kind of try to start thinking about what area you want to live in, so we can know how much the taxes are there, or do you want a condo, do you want a single family house or townhouse? So we'll know, so you can start budgeting for those things if you're going to have a condo fee or not. Now with the condo, there's some good things about you have the condo fee, but that's because they have a master policy that covers certain things that you won't be responsible for, such as like if something happens to the roof in a condo, you don't have to pay for that because you're paying monthly that premium with the condo fee. Sometimes windows are normally not included. You normally have to do those yourself. And then anything what happens with the siding, and sometimes if they have decks, need to be power washed, all that stuff, like those certain things, you're not expected to cover out of your pocket. They are covered and done on a certain timeline with the condominium you're in. HOAs with the townhouse, you would be technically responsible for your roof and siding and that sort of thing. So, and your HOA fee is normally about $80 to $100 or something. So they're not too expensive. And this is monthly amounts, by the way.
So, question for the Facebook group, Talithia.
Mhm.
So Brenda says that she doesn't like the carrying emoji as well. It's her nerves. But in regards to some of these questions you go over the questionnaire, do you have something that you can provide to the attendees afterwards?
About
Like a checkoff list of stuff that. So she doesn't know.
yeah,
she doesn't know whether she wants a townhome or a house, single family house.
Okay. Yeah, between Lee and myself, but I'm going to be sending out a home buyers guide. So some information to be in there that I'm going to email out to everybody. And by the way, you all can type in your email addresses so I can make sure I send that out to you. But it's really going to boil down to depending on what area you want to live in. So we can I can look in the system and tell you, hey, taxes in this area are range around this amount. But it's really going to boil down to the whole picture because you're with the pre-qualification, like, I mean, you're rewarded if your credit score is great, then you're going to get the best rate. And if it's lower, but you still qualify, your rate might be a little bit higher. So all those things factor into your pre-approval, and Leo cover that a little bit more.
She says, thanks. Here's my real email address, not the one I signed up with.
Thanks. We like real email addresses. We won't spam you. All right. So find a realtor. All right. So that part's already covered, you guys. I'm here for you all. So you want to make a wish list of, things that are going to be important to you with your first home purchase, and things that may be a high preference versus, and also your wants versus needs. So if you have like a dog, you're probably going to need a backyard for your dog. But do you need a garage? Or do you just really want a garage? That's like the common thing with most of my clients. They're like, oh, I want a garage. And I'm like, they're like, oh, we get too much snow here. And I'm like, you still have to remove the snow that comes outside of the garage. But, that sometimes that's just like, they're like, I really need a garage or really want a garage. So, make your wish list. Like, do you need 2 bedrooms? Do you need 3 bedrooms? Do you need 4? I had a client, he told me, this was just recent actually. He's like, yeah, I want to look at anything if it has 3 bedrooms or more. So we go to look at some houses, and we're looking, and he wanted to stay at a certain price point too. Everybody always doesn't want to pay a mortgage, even though you pay X amount of money in rent, you don't want to pay. I don't want a really high mortgage. Now, you have to do what's comfortable for yourself, but also be realistic about the amount you're going to have to pay for a mortgage, for a place to live. So, but back to him, he told me, hey, 3 bedrooms or more. So we look at the 3-bedroom house, and he's like, well, I really need 4 bedrooms because X, Y, and Z. And I'm like, okay, so why are we looking at 3 bedrooms? But he was trying to keep his payment at a certain amount. So that was taking me towards showing him townhomes, but only. Then when we saw a 4-bedroom townhouse, I know that one of the bedrooms is going to be on the lower level, and 3 are going to be up top like that. I haven't seen maybe one, but you're in a different price point where all 4 bedrooms are on the same level. So anyways, we look at the townhouse and he's like, well, I want all my kids and me to be on the same level. I try to make this work, and I'm just like, okay, so we need to be looking at single family homes, not townhouses. So our next search, we went out and looked at single family homes.
So question, Jake from the Facebook group, Juice of Water.
Mm.
Jake, he's not from State Farm, he says. So Jake says, during this whole process, have you ever ran into a situation where you guys found something and then they decide not to go with it and move on to something else? Like, say for instance, you found property, you put an offer in, and then you cancel. Now you're like, I want to keep looking. Now, are there any penalties with that?
So it depends on how far along we are in the process. If we put an offer in, it's accepted, and then you decide, you wake up in a cold sweat that night, you're like, I don't want this house. If you let me know the next day, then we can void the contract. So there's a lot of outs for buyers, actually, whenever you're going through the home buyer process. So I would say the worst case would be that you would forego your home inspection fee. It depends on how, how easygoing the listing agent is on the other side. So if they want us to really go through the home inspection process, provide the report, then, we can do that, and you would have to forego the home inspection fee. But that's better than, losing your earnest money deposit or buying a house that you don't want. So there are outs for you to do that, but it just depends on how far along we are in the process. But I could void the contract. We could just say, I've had somebody, they were in a bidding war. There were 6 offers on one of the properties we flipped, and she just came back the next day after we had went with their offer and said, my clients withdraw their offer. And I'm like, okay. So anyways, everybody does it differently, but that's potentially the obstacle that you may have to face, is just having to pay the home inspection fee to get out of the contract.
He wrote, thanks.
You're welcome. All right, so then we're gonna, view the homes. So my goal is to only send you homes that are gonna be, potentially an option for you. And so we narrow down the criteria in the beginning so that we're not just like looking at any and everything. Like I have a client right now, she wants, so she really wants a garage. So I'm like, we just need to look at houses with garages. And she wants a lot of closet space. So I'm not going to show her houses that they look nice, but I know they don't have the closet space she wants, because she's going to be contemplating like, so we're only looking at homes that I know offer a lot of closet space and have a garage for her. That's all I'm sending her. And that's worked so far. Actually, we put an offer in, but the seller decided, and this is the first time this happened, she decided she doesn't want to sign a contract until she finds a place to live. And I'm like, this isn't how this works. But that's what we're going to do when we go view homes. We're going to be looking for homes that are actually going to be potential options for you based on the photos and the description of what the home offers. All right, so, okay. So then once we find a house, we're going to make an offer. Now, once we determine that's the house you want to purchase, we're going to pull comps in the area of what the other homes in the area recently sold for. And then we're going to make our offer based on that and kind of other things going on in the market. Like if there's more than one offer, you may have to submit an escalation addendum, which is basically saying like, hey, I want to pay this much for the house, but in the event you get an offer over this amount, I'm willing to go up to this amount. So there's different things to be more competitive with the offer, but that's pretty much what we'll be basing it on. We'll look and see in the past how much seller subsidy or closing costs have the seller contributed to that purchase. So well, contributed to the buyers that have purchased previous in that area. Sometimes that, you know, sellers will expect to have to pay some of the closing costs, but again, it's just going to depend on what type of market we're in. If we're in a seller's market and there's somebody else that's going to come in with an offer and they don't need any closing costs, then you have to just determine, like, you know, how competitive do you want to be with your offer. And I don't submit lowball offers if I know that the house is priced right. So unfortunately, I won't be able to. I met with somebody one time and they were like, they wanted, the house was like close to $1 million. They wanted to submit 200,000 less, and I was just like, I'm not the right realtor for you. So I don't submit like insulting offers, because a seller can just reject your offer. They don't have to counter it. They can just say no thanks. So even if you want to submit 30,000 less or something, I just, depending on how the house is priced, then I potentially won't do that either. All right, so inspections and appraisals, we talked about this already, and then just to elaborate a little bit more on the appraisals, they're going to be assessing the value of your house. So, with the house that you're going to be purchasing. So what they're going to do is look at homes in the area that recently sold in the last 90 to 180 days and determine what the value of your home is based on if the house has had upgrades and that sort of thing. So it's going to be based on that. Now, if the appraisal comes back where, let's say we offered $350 for the house, we're under contract for that amount, and the appraisal comes back at $360, then congrats, you have 10,000 equity in your house. And that can happen. That's happened for me several times now, or even 15,000 equity. Now, if it comes back at the actual value that we call that just it met value, then you're just paying, you know, what we contracted for you to pay. Now, if it comes back at 340 and we are under contract at 350, we will probably have to go back to the negotiating table, because the lender is not going to fund the loan for more than what the house is worth. So we have to go back and ask the seller to reduce their price. But at the same time, if they've already agreed to pay a certain amount in closing costs for you, then we may have to renegotiate that, because all of this comes out of their bottom line. For if they're giving you closing costs, they're paying, and then they have to drop if they're giving you 10,000 closing costs and they have to drop their price 10,000, then that's going to be a lot of money on their end. So they they don't have to agree to do it, but at this point in the process, excuse me, it's not COVID. At this point in the process, though, most people want to just get to the settlement table, because you as the buyer have already invested money and time. The sellers have invested money and time. Then we're trying to make it work in the end. So that normally doesn't happen in most cases, but sometimes it has happened. So that's just something to let you be aware of. That could be a potential situation. And with the inspections, what's going to happen is anything that's done, inspected, and a lot of people don't know the full condition of their house until inspection's done. So the seller may be surprised about certain findings that the inspector finds during the process as well. But anything that we do, when we do the inspection, if we find out, hey, this isn't working properly, or this needs to be fixed, this needs to be replaced, then we're going to have an inspection report, and then we're going to have a list of items that we are going to request that the seller fix or repair. So they could come back and say, hey, I'm taking care of this and this, but it's also going to matter about how much they've agreed to cover. Like I have somebody under contract right now, the seller is paying $6,000 of their closing costs, but we were trying to get $8,000 to cover everything, but they're paying $6,000. Now with the home inspection, they agreed to do everything that we asked, but that's because they didn't have to pay all of the closing costs for us, you know. So everything matters on both parties, and I mean everybody's trying to get the best deal, but in the end, you just have to be realistic about some stuff. Like they may take care of certain things, but and it definitely, if it's something that's going to be a lender issue, they're going to take care of it far as the inspection goes. And then if it's something that you, I mean, would assume that is working. So let's say we find out that the HVAC needs to be serviced and maintenance because it hasn't been for several years, then they're going to do those type of things because that's what you're expecting whenever you're going into another home, not that the HVAC is going to break down on you next month. And then depending on what they say they're going to take care of or not take care of, then you can decide at that point, hey, do I want to move forward or not? So just keep that in mind. And so that's basically kind of like what we were talking about with renegotiating those two things, depending on what happens. And then you have your closing day. So what we're going to do is if the seller has agreed that they're making repairs, they're supposed to send us receipts from the contractor stating that they paid those things. And I mean, paid to have those things done, or they're giving us a credit or that sort of thing. But we're gonna do a final walkthrough of the house before we go to closing to make sure that those items were taken care of and repaired or replaced like they said they were going to in the contract. So, and then we will, like I said, have the settlement date. And now during that, sorry, I think this is kind of just a roadmap to this same thing we just discussed. Yeah. All right, so I usually go to closings all the time. And then we also review all the documents that well, not all the documents you're gonna be signing, but the ones that are important, like with the numbers, right? Like, hey, what's my payment gonna be? What's my interest rate that's locked in and all that stuff. Now, during right now, depending on when you're going to purchase with COVID-19 restrictions, they told me I can't come to the settlements no more. So I'm there with you at walkthrough, but unfortunately, I'm not going to be able to be there with the actual settlement.
So Lisa in the Facebook group has a question for you. Want to get some water? She's like, you just mentioned you can't be there for my closing, but I've been following you on Facebook. I saw you holding a key with somebody the other day with a mask. Can you still do that at least?
Somebody really said that?
Yes. Look,
yes. Hey, everybody has to hold the key. Everybody has to hold my key, okay? I'm tempted to grab it to show it to you. But so that was at the walkthrough. So, and they told me I wasn't gonna be able to be at the settlement. So I just found out then. All right, so that's my key. So yes, you will hold the key, Lisa. Now, I'm hoping that, we can attend them, in the near future at some point. But as of right now, like I can zoom in to be present, but the title company that I work with, they're really loyal and legit. So like, I don't have any concerns with them, like making sure everything is good to go for you all. So yeah, but I'll be there with my mask if I can be. Okay, so
Lisa says, okay, I'll hold you to
it. All right, I'll be there. So let me make sure there's nothing I missed. And all right, so yeah, of course you need identification, right? Whenever you're purchasing your house, they have to verify that the title company, they're going to take pictures of it and so forth. And everybody that is responsible for signatures, whether you're just going on the title to the property or if you're actually on the loan, you have to be present to sign. And if not, you need to let them know in advance. And then if you, of course, have any money due at closing, you can wire those funds to the title company beforehand, or you can bring a certified check, either or. So those are the things you will need during your closing day, and then you get your key, of course. So now during that whole process, whenever we're finding a home under contract and so forth, simultaneously you're going to be providing docs to the lender, getting everything covered on their end that they need from you. So it will seem like a kind of a stressful process, but our goal is to make it the least amount of stress as possible. And working with Lee, she's a solid lender. So like, I know that if she says you're pre-approved, as long as you don't do anything like going out, hey, I went and bought a car or something like that, then I know that you're, good to go, and we'll get to the settlement table. So I have a lot of confidence in that part. But I think that's pretty much it for my piece. This is my contact info. Oh, all right. So, but yeah, y'all can find me on Facebook, or message me. I mean, if you have any questions about anything, just let me know.
Cool. So thank you, Talithia. Right now, we're open up for a little questions, Q&A for Talithia. You guys have any questions? If not, we'll move on to Lee. I'm going to open up for like, I don't know, a couple seconds here. So you may feel free to write in the group chat or unmute yourselves. Going once, going twice. All right, so our next speaker, Lee, are you there? Cool, all right. So this is Lee Fry. She is Senior Vice President for George Mason Mortgage. I'll pull up her slide right now. So Lee, just like last time, let me know when you want to move on to the next slide. I'll click it for you, okay?
Okay, all right. Well, I hope everybody's having a good day. At least we have some sunshine outside, which is much better than all the rain we've been having. So anyways, let's just get you started so you understand the basic steps of getting a mortgage. It's not that hard. You're buying, when you're starting to buy a home, what do you have to start with? You start with your credit report and your qualifications. So the best way to get started is you're going to fill out an application for me online. And this screen here is the basic screen of buying a home. What are the benefits of buying a home? The benefits, of course, you're building equity. Right now, you guys are paying rent. So you're paying someone else's mortgage down every month. So you're building equity for your landlord right now. And then, of course, when you own a home, depending on the mortgage interest and the tax properties, you should be able to write it off. It depends how much it is, because right now we have a standard $12,000 a year for a deduction, but usually when you're buying, it's going to be more than that, and you'll have that. The long run, when you look at what your write-off on a mortgage is and what your home payment is, plus building equity in the house, that's the whole thing. Keep in mind that yes, in the beginning, it's going to seem tight, but you're paying down a mortgage. You're paying your mortgage down every month, so you're building your equity. Plus, we're in the metropolitan DC area. You might not gain equity overnight, but you will gain equity owning a home. And you got to get your foot in the door so you can start building your wealth. And then, of course, right now, you're just living in a house. You're not living in a home. When you live in a home, you can paint it the way you want, you can decorate the way you want it. And it's just, bottom line, it's home. And that's what it comes down to. And even more important now with what we've been going through when we've been in our house, that it's comfortable and it makes you feel good. But let's get you started on what you need to do first with buying a home. The best thing is going to be, we need to pull your credit report. So Talithia touched on it quickly, and what the credit report does as a lender, there are 6 algorithms. When we pull the credit, there's 6 factors in the formula. When you just do an inquiry online, there's only 5. So that's why we get a different credit score than what you're going to see if you just inquire. It's basically a different calculation. So you need a lender to pull your credit. Maybe if you're not ready now, it wouldn't be a bad idea, because I just pulled someone while I was listening, and there's stuff on there that's not hers, and we're going to have to get it fixed. So we review the credit with you. We'll go through it. Today's world, because of COVID, the guidelines are getting a little tougher, but you do need a minimum of a 620 for our first-time buyer programs. Now, I will warn you that on a credit report, how do I get my score there? A lot of times, first-time buyers have a credit card that maybe the limit's only 300, and you charge that month 200. Your score is going to drop. Try to keep your credit card limits 30% or less. That will be the best for you. And also, you don't want to overdo your credit. In other words, you don't want 10 credit cards that you're using. Don't close them, but try to use 1 or 2 at the best you can. Another thing, any lates in the last 12 to 24 months really can affect your credit. So get a credit report, review it, go over the scores with the lender, and see if there's anything we can do to fix it and get your credit better. The next would be, so we've pulled your credit, we know what programs you can go into, so now we got to see how much money you're going to need. I just did someone with a first and second trust, 100%. Seller paid 3% of closing costs. He needs $1,000 to get in the door. But that program also required him to have 1% in reserves. What's reserves? It could be your 401k, it could just be your checking. The big thing on a down payment, we can't use cash at home. We have to see it was your funds. It can be gift funds, but it has to be from a family member. It can't be from your best friend down the street. So if you are a person that believes in saving money at home and you're thinking of buying in the next 6 months, I would encourage you to put the money in the bank, let it sit there, because the lender's going to ask for your last 2 bank statements. We want to see, we're looking at your bank statements to see that you manage your money well. We're looking to see if you have any other deposits that we're not aware about, or another debt. What if you made you make a child support payment, but it wasn't court ordered? Well, but it comes out of your paycheck every month, or I'm assuming your bank statement. We look at the activity on there. So it's very important that when you sit down with the lender, you explain every debt you have, you go through your credit report, and then we're going to figure out how can you save for your down payment and the money you need for closing. Average closing cost is 3% of the sales price. So, and again, when you're writing a contract, and this is Talithia's cup of tea, when you're negotiating, a seller can pay up to 3% of closing. Sometimes it covers it, sometimes it doesn't cover it all, but it's going to be part of your contract. And again, when we're writing a contract, I'm going to do worksheets, all different programs for you. This is what you need here, this is what you need there. So the bottom line with cash to close, usually you need a minimum of 1% of the sales price. And even if you've got a 100% program, you still need funds up front, like she mentioned. You have to put a good faith deposit down. It's called an EMD, an earnest deposit. You need to have a credit report fee paid, appraisal fee. If the seller comes back and says they're going to pay all your closing, well, at the end, when you go to closing, you'll be getting these funds back. So we'll go through how the numbers work and how everything does. Next, we determine what can you afford. Well, in today's world, what we look at is your ratio. What's a ratio? So let's say your income monthly is, let's say you make $4,000 a month. The max ratio you can have is 45% to qualify for a mortgage. 45% of $4,000 a month is $1,800. That means your car payment, that means any credit card, any bills on your credit report, not car insurance, not your cell phone, not your utilities. They use 45% because they know you have other bills. So this is how we determine what you qualify. So if you take your monthly gross, not net, monthly gross, normally 45% is the max ratio. Sometimes we can go a little higher depending on the loan programs. And you deduct off what bills you have to pay. That's how we'll figure out. You have a car payment of 400 and the max was 18, then the max home payment would be 1,400. What does that mean? That your principal and interest you're paying on the mortgage, any real estate taxes, any home insurance, if it has mortgage insurance as well, two different things. Home insurance is to protect your home as far as if someone robs you, it gets damaged as far as flooding, tree hits the house, things like that. Mortgage insurance is to protect the lender in case you default on the loan because you haven't put 20% down. So there's two different numbers there. And then the last number would be an HOA or your condo fee. So there's 5 fees that could be in your total home payment. And then from there, we've gotten you pre-qualified. We say you can buy a house for $250, subject to the condo fee not being more than $100, or HOA. I mean, we do all these scenarios for you. Then I'm going to tell you, don't go shopping. Don't change anything on your credit report. That's the most important thing. We don't want to have any major purchases. Once you've made that decision to buy a home, we got to stop shopping. So you've got to learn a budget. And that's the biggest thing right there. Your whole key factor in buying a home is a budget. So it's simple. Piece of paper and a pen, write down what you bring home every month, take away what bills could you pay off, what bills do you need, what could you eliminate, and then from there you know your monthly budget. So from there you bring home $4,000 a month, you know what you have to pay in bills, how much left over could I put away to save for a down payment or for earnest deposit. Because again, if it's a 100% program, you still need some fees paid up front. Yes, they might be refunded, but you need money up front. And then where we go from there, so now we've identified you can buy a house for $250. You know you need a minimal, let's say $5,000 to buy, provided the seller paid closing, so you could get started and you could get out there home shopping. So I've given you a worksheet. I've showed you how much the payment would be. We go over it with Talithia, and then she knows, oh, well, this condo fee is $600. It won't work, so we have to back off. Or I had one the other day. I told him the max he could do was $260. We put in HOA. He found a single family in Stafford, for an example. Taxes were less, and there was no HOA. He bought $300,000. So that's a quick math. In other words, letting you know we have to look at the total picture of the puzzle to figure out what can you buy. So some factors could change, no HOA or just taxes are less or things like that. So that's how we have to stay within your budget. So we go back and forth. I have people all the time sending me a listing saying, hey, what about this or that? Can you run me numbers? I'm a person that I believe you need it in black and white in front of you so you see your payments and different programs. And talking about loan programs, there's most first-time buyers go through a program called VHDA. If you want to look it up online, it's Virginia Housing Department Authority. And that program right there, and I can send you literature on it, it offers grant funds, it offers 100% financing, it offers some money towards closing costs. So it's an excellent program. And on their website, they do have a first-time buyer class. I would recommend everybody take it. And this class will teach you what is everybody's job. What is the lender's job? To help you understand your financings, to help you understand your budget, to help you understand total cash to get in a home. Next, what's your realtor's job? To help you find your home, the house that you're dreaming about, to get a good negotiation, to work from there. And then your next would be the home inspector. So, this online class is going to teach you from a home inspector to the title company to at the very end. But no, you can go on to that. That's fine. The next screen's fine. But that's what I'm saying. I'll send you the link out. I would recommend anybody looking at this first-time buyer online. It just you understand all the steps in buying. So, and then as we know, your agent is Talithia. You've already picked her. We know that. And then what you're going to do, I've given her all the worksheets. She's going to go out there and try to find what you want to buy, what's going to be good for you and your family. And from there, you've already gotten pre-qualified. You're done. I've given you a letter, and I'm not going to pre-qualify you. I'm going to pre-approve you. There's a big difference. So when we start with this process, and you would fill an application online, I'm going to ask for your W-2s. I'm going to ask for your pay stubs. I tell everybody, think two, two, and two. 2 pay stubs, 2 W-2s, 2 bank statements. I'm going to get all that from you. So when you've been out there with Talithia and you're looking to buy, you're going to have an approval letter. So that your contract would be looked at very strongly because you're ready to go. We don't want to disappoint you, go look at houses, and then something comes up. So I'm going to ask for all your documents ahead. Okay, go to the next one. Oh, there's more there, sorry. And then, so with all that, and that's where I'm getting to, she's going to make a good offer for you. She's going to do comparisons. And what are comps? Talisia's going to pull, you found a townhouse you want to buy. And what you're going to do from there, she's going to see what's sold in the neighborhood. And she's going to help you structure your contract. She's going to, and we're going to also consider maybe one sold in the neighborhood for $250, but they had no closing costs. So that's a big difference if you went and offered $250 with closing. So sometimes you might have to offer a little bit more to get closing costs. So there's different numbers. And again, that's where she's going to come in and help you negotiate, get your final price. And once we do have the contract, that's when we start the whole ball, the official loan application. I can get the official loan approval. So that's what's going to happen there. It's that you're going to have your contract. And when we get that contract, you do your home inspection first. So a home inspector, tip of advice, you want a home inspection if you can, let alone he's going to tell you about the house and, that it's sound, that it's structural, that, it's a good quality house, that there's no problems. But he's going to teach you about the home. He's going to teach you where the water cutoff is. He's going to teach you how to run the furnace. He's going to teach you the mechanism, or however you want to say it, of running your home. And it's very important. So you've done all these things. You've gotten your final price. The next thing we've done, we've got final loan approval. And at that point, you're ready to go to closing. And so you're ready. At that point, you sign on your loan papers. That's the day you get your keys. Everything's recorded that day. So you can't go shopping yet. No new bills yet, because we got to record everything. So don't think about buying that new furniture until about a week after closing. Keep that in mind. Don't go buy anything. So the next step, you've negotiated, you've done everything. And now we're going to get into how did you qualify. I've kind of run some of this together talking to you. The big thing you're going to know is your budget. And that's where I got off into the other subject about it. Your monthly savings and your monthly expenses. Look at your ATM. So many people use an ATM and they, charge a coffee here, do this, do that. Try not to use that. Try to put a little cash in your pocket. You're going to see how quickly that cash goes. Sometimes that ATM card can get us all in trouble for our monthly budget. So really look at it. And there's nothing wrong with, like I said, start with your net you bring home and then go from there, write down all your expenses that you need, because none of us like to be house poor. All of us want to be able to still, do things that we enjoy. And it's even more important now because what we've been all going through with this, we are similar. We can't go out like we used to, but we got to have the emergency funds in case we got laid off or our hours were cut back. So I always would encourage people, always have a couple months of house payment and reserves if you can, because you never know what can happen. And that's the important part about buying a home. Really get on a good solid budget before you go. And then that way you can save some money when you're, as far as after you've gotten in the house. Hopefully you can still, even if it's $25 a pay period, every little bit helps. So that's where we're at there, is that we want to make sure you're comfortable and where you're going. The next one is, what can I afford? And again, that's where I talked about how we determine it, what you do. We look at everything. We're going to look at your credit. And let me talk about credit. Let me talk about, everybody's been hearing on the news the word forbearance. Forbearance can be really the ugly word. Try not to do a forbearance. Forbearance means, in the lending world, if you've done forbearance on your current mortgage, that means you're in trouble making your mortgage payment. You cannot get a new loan for 3 to 4 years. Be careful on a forbearance. Really talk to a financial advisor before you do it. I had a client the other day, He told me he did it on his current home loan. He had the money in the bank and he's still working, but he said, oh, I'll just have free money for 3 months. Don't look at it like that. You can make your bills, make your bills. Do not do a forbearance. It will really hurt you in the long run. Next thing will be your down payment. Down payment cannot be cash, as we mentioned. It can be gift from relatives. It can come from your 401k. I had someone just cash in their life insurance policy because it was a cash value. If you have a car, you want to sell a car, I have to see that you own the car. I have to have a copy of the title. I have to have proof who the buyer was, blah, blah, blah. I have to see where the funds came from. So again, any cash deposits, we have to source them. The purpose behind sourcing cash deposits, we have to make sure you didn't go get a new loan, that you have a new debt that we're unaware of. And the next thing, is your income. We have to see it's solid. So how do we qualify on income? Your W-2 person, you're simple, easy. Your salary person, we already know. Your commission, let's say your car salesman, have to be in the line of work 2 years when you're a commission. I have to see stability. So if you just went on commission, we can't count it. If your job, another example, you get a bonus at the end of your profit, but you've not received it. You just started a new job, you're in IT, and they said, we're going to bonus you once a year on the company profit. Well, we can't count that if you don't have a 2-year history. Everything's 2-year history. Another thing, you're a realtor. You're self-employed. I have to have 2 years of your tax returns. You're doing a Schedule C when you're self-employed, or maybe you're incorporated. So keep in mind, if you're not a regular salary person, we have to look at all source of income, how you get your income. So we do look at that. And again, getting a mortgage is kind of like a puzzle. You got to let your lender know everything. This is my income. This is how long I've worked there. They want to see a work history. If you've had 5 jobs in the last 5 years and it's all different fields, that can be an issue. They want to see stability. Think of, they want to see you're solid, your income is going to continue. And then also your debts. They're going to look at it. If you have any debts that's going to be paid off in the next 6 months and the payments aren't really large, most of the time we don't have to count them. So we are going to look at your debts on your credit report. We're going to look at your income you bring in. Let's say you're divorced and you get child support or you get alimony. We have to see you receive it. Just because your court order says you should receive it, we have to really see you have. I'm trying to think out of the box what other items would be for income. Social Security, maybe you have a child that a father had passed and he gets Social Security. But if he's 15, we can't count anymore. If the income does not consistently continue for 3 years, we can't count any income like that. So again, you just need to figure out exactly what you have, talk it over with your lender, and they'll send you in the right direction. Bottom line, don't hold anything back. We always find out. We do so much now, fraud reports and everything, we'll figure that out. The next one would be on your credit. How important is your credit? Well, that's the whole key factor. Make your payments on time. That's the biggest thing they want to see. Try to keep your credit bills, like I said, your credit report's less than 30% of the limit. That will help. Make sure that you haven't had lates in the last 12 months. If you've had any late payments recently and something has happened, some creditors will consider and they will remove it. So talk to your lender. They'll give you advice on how to get it off your report. I tell a lot of people use, hey, my job has a clearance. I didn't realize that payment was late. Could I have a one-time courtesy removal? A lot of times they will do it. They want to make sure that you keep your job. So if you have something that's affected your credit, get some advice how to go back to that creditor and see if you can work it out. Sometimes they'll say to you, if you pay this off in full, we'll permanently delete it. Get a letter in writing, and then whatever you have to do, and then, pay the debt off, but get that letter in writing, they would do it. So your credit scores, there's different factors of how it is. Most programs, first-time buyers need a 620. Some other programs we have need 680s. Every program needs a different credit score. The higher the credit score, the better rate you will get. The better PMI. PMI is private mortgage insurance because you haven't put 20% down. Everything you will get as far as what you're quoted is based on your credit score. And it's going to also based on the loan type you're doing, 100%, 5% down, different type of loan mortgages that you would be offered. So you have to look at everything you have. I think that pretty much says that. Then what's the lender supposed to do and what they're expecting? And I pretty much hit this. Got to have at least 620 today. Cannot have your ratio over 45%. 45%, take your monthly gross times 45. Back away your debts, then you know your housing payment. The lender's looking to make sure you have the ability to pay the loan back. In today's world, because of COVID, we have so many more restrictions. To give you an idea, I have to go back the day of closing now and verify that you're still on your job. It used to be 10 days before. I also have to pull what's called a soft credit report the day of closing to see you didn't buy anything new. So there's a lot of overlays that we have to do. We have to see that you're a strong buyer. We all understand we can lose our job tomorrow, but the day you close, we have to make sure you are solid and that you're good. How do we verify this? We're going to get your W-2s. We're going to get bank statements. We're going to get your pay stubs. We look at your pay stubs to see if you have any garnishments. Maybe your IRS passed taxes and it's garnished. That's a debt. A lender's going to look at your bank statements to make sure you don't have another debt. It's a private loan. Well, we're going to look to see if it's coming out. That's what they're looking at. We also have to get transcripts. So if you give me a W-2, we have to go to IRS and get a transcript from IRS to make sure it matches. So, bottom line, we have to check everything you give us. And then from the lenders, every lender, every mortgage company has different programs, different guidelines. Pretty much everybody's straight out at 620. We used to be at a 580. But and some lenders only do a 660 or 680 now. So different programs, the higher the mortgages, the harder it is to qualify. And what I mean by that, like a jumbo loan. So, and that's usually not where I'm at, but every loan is different and different qualifications. So you might shop online and hear, well, I can get this loan, but it's tighter to qualify. It might not be a back-end ratio of 45%. Again, what do I mean by 45%? I mean that it's not going to be, maybe the back end is 42. You can get into a certain program, but the ratio is tighter. So again, every lender is going to be a little bit different of what they have. Let's see here. There's a question in here, someone, I think we're all good. Never mind, I read that wrong. Okay, so we're good there. But pretty much even credit unions have different programs for you guys. So we need to look at every program that you could do. And first-time buyers, there's tons out there for you, from the county to the state with BHDA. How do we improve or establish your credit? You're going to be doing it by numerous things. If you have a credit card right now and you're at the limit, then try to pay it down before a credit company, a lender, pulls your credit. If you have a collection on your credit report and you know about it, a medical, $45, let's say, guess what? Leave it alone for right now. Let the lender pull your credit. When you pay, oh, I just lost my screen. Hold on a second, guys. Oh, there you go, sorry. When you pay off a small collection, it reactivates it that day of your credit report. So how to improve it now? If you have any credit report or any credit cards you can pay down, pay them down. We used to do alternative credit. That pretty much has gone to the wayside right now during what we're going to, but it is something sometimes we can do in the future. And what we mean by that, your cell phone is not reported, but you pay it on time every month. We get a record of that. We can use it. Let's say, or auto insurance. That's another way to do it. Or your rent, things like that. But I would consider I wouldn't worry about paying any loans off, because installment loans do not, as long as you're paying them on time, doesn't improve your credit score. Credit cards improve it, and if you can remove any lates. But if you have a small medical collection, don't touch them. Leave them alone. When you pay them off, and it was from 4 years ago, guess what? It comes back on you, makes your credit report go lower. You don't want that. Where are we at next? What's in your house payment? Principal and interest, that's what goes to your mortgage. So that's going to pay down your loan every month. Taxes, insurance are in there. You have what's called an escrow. An escrow is a savings. It's the easiest way to explain it. So every month, a lender's going to collect your home payment. Real estate taxes in Prince William are due twice a year. They're due in July and they're due in December. So we collect it in your house payment, and then we pay it twice a year. But it's easier to collect a little bit every month and have it in there for you than to get a big bill, earlier in the month. I keep doing that. What am I hitting wrong here? Let me go back. Okay, sorry, I hit that again. Anyways, so you're going to have your escrows. Insurance. Someone asked a question about insurance. So if you have renter insurance now, when you go to buy a house, you're going to buy home insurance. You're always 1 year paid in advance on a mortgage on home insurance. So when you've been sitting in your house payment every month, your home insurance is part of it. So next year, let's say you buy a house this June, and next June, when your insurance policy comes due, the lender will pay it for you. So it's collected. Taxes, insurance are broken out annually, every 12 months. And when the bills come in annually, we pay them. So it's much easier to pay a little every month, and then you're not worried with a large bill later. The lender is assured that your taxes are paid on time and your insurance is paid on time. But that's what it means to be PITI when you hear the term. That's your house payment and your taxes and your insurance. The other thing that is not in there, which would be if you had mortgage insurance on the loan, that is something that would be paid directly to the mortgage insurance company. And the last thing, part of your home payment would be your HOA. And that, of course, is paid separately, and you would pay it separately. You wouldn't pay it in your house payment. You would pay it to the HOA. So why could you be denied? Credit score is too low. Your ratio is too high. You may have too much debt currently, so we have to buy less. You don't have enough money in the bank to make the deal work. The house, this is something that usually isn't a problem, but let's say you buy a house for $300,000, it appraises for $290,000. Well, at that time we go back and we say, I send it back to the agent, and I tell Talithia it came in at $290,000. They're going to go back to the seller and say, my buyer still wants to buy it, but we have to lower it to $290,000 for the appraised value. That's why an appraisal is done on the home, to protect your value on the home. So we want to make sure that you're protected and what you're buying. If they refuse to do it and you choose not to pay above the price, which I wouldn't blame you, then at that point we cannot do the loan because it didn't appraise for the value. Or if the house has major structural issues, we cannot do a loan for a home with major structural issues. And the last thing would be the bankruptcy or foreclosure, and you haven't had enough time to recover from it. So foreclosures are 4 years or 3, depending on what type of financing. Bankruptcy is normally 2. So keep in mind, and that's where I come back to forbearance. They're looking at forbearance in the credit world today, and it could change because we get new guidelines. I've done this for many years. We get new guidelines every day. Right now, if you do a forbearance, you have to wait 3 years to get a mortgage. So keep that in mind. Well, we're going to figure out what loan's going to be good for you. and what's the difference between a conventional or an FHA. There's numerous loans out there. FHA, sometimes we do that because your credit score is below 680 as opposed to a 6. If you're above a 680, we're probably going to go conventional. The computer usually doesn't like it if you're less than a 680. FHA has a 3.5% down payment. Some conventionals go from 3% to 20%. But again, we go back to the VHDA program. So we connect them. VHDA is Virginia Housing Department Authority. They offer the grant money. With that, then what we do is FHA, we connect the two. We take VHDA's funding of the grant and we do an FHA loan, or vice versa. We would do conventional, where it's 3% down, and we do the grant. The bottom line with both programs, even if one has 3.5 and one has 3, you need 1% down if we do a VHDA. So FHA is the easier loan to get approved, and that's why a lot of times we go FHA, because sometimes first-time buyers haven't established enough credit, or maybe they had a ding when they were in college, they let a bill go. I mean, there's always, and we also have life, things do happen. So we have to figure out what loan would be best for you. And give you a rule of thumb, if every $10,000 is going to change your home payment $55. So keep that rule of thumb in mind. So as far as qualifications or negotiating on a price, maybe you want to go up a few dollars. It's not going to be a major thing to say, I want to get my closing costs paid, and they're asking $250. Maybe I go up to $258 and get the $8,000 to cover closing. Your house payment went up about $40 some, $45 maybe. And that way, you know, you can negotiate. What we have to do again is come down to your budget. Are you comfortable with your house payment? Are you comfortable with the cash to close? And what program is going to meet you best into qualification? Should we go conventional? Should we go FHA? Now, I didn't really put in, maybe the next slide has it, VA. VA is for veterans only. So when you hear about a veteran loan, that is if you're in active duty or you were in, it's 100% financing. If you have VA disability income, you don't pay a VA funding fee. So if you have the ability to go VA, it's the best loan out there. 100% best interest rate. You know, it's the best one hands down. And if you're not sure, let's say some people were reservists. You have to be in a minimum of 6 years, but if you didn't serve enough tours, you're not, you know, that doesn't work. Again, go to your lender. They can pull your eligibility on a VA loan directly from VA, and we can help you. If you have VA eligibility, that's your best loan to do.
Hey, Lee, there's a question coming in from the Facebook group from Terrence. He says he's service member right now. He lives in a house with him, his wife, and his daughter. His daughter is 24 years old. She has really good credit. Would it be possible if him, the service member, have his daughter co-sign because the wife's credit is bad?
No, it has to be only a spouse on a VA loan. That's a good question. So you cannot do it. You can only on a VA loan yourself plus your spouse. That would be it. So if that was the case, you're trying to do something, you might want to look at the two of you doing the VHDA loan. She could be on that. But on a veterans loan, the guideline is only you and your spouse.
All right. He said thanks, and he put the care emoji.
Okay. Any other questions on the VA? I don't think so. All right, discount points. What's that? There are so many languages and so many terms that we use that you guys, you know, I hate to say I started this in '84. I've done it a long time, and sometimes I talk too fast because it's my cup of tea. So, you know, you have to slow me down. So discount points, what that means, the lower the rate, the more you're going to pay in points. But when a lender does a worksheet for you on an interest rate, let's say today 3 1/4 has no points, but you could go to 3 1/8 for 1/2 point, and you're doing a $100,000 loan. That's going to mean it's going to cost you $500 more in closing costs because of half of $100,000, but your payment will probably change $11. So you would have to look at the overall effect. Is it worth to pay points to save $11 a month? And that's just a quick example. Most of the time, it does not make sense to pay any points because usually you want the closing costs, and closing costs is 3% and points would be on top. So when you hear the term points, you can go on websites and see things online all the time. Example, Navy Fed, if you look at that, look very close on their VA rate today, it shows you 2 points. And if you read below, it also says 1 origination, 3 points on that loan. So you have to be very careful that you understand what rate you're getting and what point when you are shopping online. That's the important part. But points, the biggest thing about points, you're paying for it up front to lower the interest rate. This is your first home. Average turn in a first home is 5 to about 7 years. You'll never recoup the money on a discount point. So don't get so much hung up on the lowest rate. Look at your payment. But that's what you're talking about on a point. I can always give you a lower rate, but it'll cost more money up front. I'd rather you, if it was 1 point and you bought 300,000 and it was 3,000 more to close to go down a quarter in the rate, I'd rather you have 3,000 left in the bank to have reserves for your home payment. And when we do the numbers, we would show you how that works. Annual percentage rate. Everybody sees an APR. Guess what? Your APR is higher than your note rate. So your interest rate could be 3 1/4 and your APR could be 3.87. Why? On an FHA loan, you have, or conventional, you have PMI. PMI makes your note rate go higher. So that's the difference there. So don't look and get so hung up on your APR. Yes, it's important, but it's total cost to buy. So it's all the fees associated with buying. Even if the seller's paying it, it's total association with buying. So, but an APR can throw you off and you get confused with it. It's when the PMI is a factor in the loan, and it will be higher. So do not be nervous with your annual percentage rate. Look at your note rate. Your note rate is most important, and how much that PMI is monthly. We have to look at both factors. Sometimes to give you an example, FHA has a monthly PMI and an upfront PMI. There's 2. Conventional, you can sometimes do an upfront or a monthly. So there's different programs on PMI. Sometimes it's better getting a higher interest rate going conventional because the PMI, the factor is usually lower than the FHA. So again, it's so much parts of the puzzle, not to confuse you, but we have to look what program will weigh out, and it's going to come back to your credit score. The lender's going to say, well, you want to go this way, even though your rate might be higher than an FHA, because PMI on an FHA loan remains on the loan for life. Conventional loans, it comes off when your loan is paid down to a 78% if you start it with PMI. If you put 20% down in the beginning, you will not have it. So your APR can be totally different number, and it's all fees associated with buying. So I briefly talked about pre-qualification and approval. Pre-qualification is when I just pull 2 people's credit, but I don't have any docs. I can tell them, based on what you told me, that's what you qualified for. Based on what you put on the application, that's what you qualified for. To get a pre-approval, that's when I've gotten your W-2s, I've gotten your verification of employment, I see your bank statements. That's the major difference. So you want to really try to obtain a pre-approval instead of a pre-qualification. And also understanding what you need to do to get to that. You need to understand with your lender exact docs that they need to see. And the other thing we've already talked about, we talked about major purchases, but we haven't talked about job switching. It's important to not switch your job during buying a home. Talk to your lender. Maybe you did get that incredible opportunity. But we need 30 days of pay stubs. If you switch in between, guess what? You can't close. So when you start that loan app, if anything major changes, go back to your lender. I had this happen. Or again, I'm bringing COVA up. I had a gentleman who just settled. Job stayed, but upper management cut all their income 20% so they could keep everybody on, and he was upper management. So he still qualified, but he came to me immediately and told me to make sure the numbers were fine. So again, the more you can tell your lender, the easier it will be through the whole process. So, buying a house, you're going to be nervous, you're going to be scared, you're going to be excited, you're going to say, oh my God, why'd I do it? You're going to have buyer's remorse, you're going to be all over the place. And guess what? You're just normal. But if you have everything up front laid out and you're ready to go and you understand the numbers, you understand the math, you understand what you need, then you know your payments. Then from there, once you figure out what your dollar will buy you because you've been out home shopping and you find the right home, you're ready to go. And then you will feel more confident that you understood the whole process because you got the approval out of the way, you understand how to do that. Then you went out and you found the homes and you saw the market, what it can do. So once you've determined the right home and the right loan program, it's all easy. It's not hard. There are a lot of questions asked today, but we're doing it to everybody. And keep in mind, the reason we do that to make sure you're well qualified and everybody buying a home are going to be able to make their home payments so we keep your future values up. And honestly, it's not hard. But if I can help you, here's all my information. You let me know. If you're not ready to buy and you think you might have a credit issue, I'd recommend filling a basic loan app online on my website, because at least I can walk you through and explain what's on your credit, what you can do, give you advice how to improve it. And you never know, sometimes you might be ready, but they cannot show you a home without getting pre-approved. So that's where you need to start. And then we can go over budget. And if you're not even understanding all of it in the beginning, you don't want to fill the loan app, but if you want to talk numbers and just financing, give me a call, I'll walk you through it. Buying is great. And once you get in it, you're going to love it. So any questions, let me know. They'll send you back my emails and all that's information. We'll get yours, and I'll send you some information out as well.
Okay. So at this time, what we're going to do is we're going to open up for discussion between Lee herself here, which she's covered the living part, and Talithia. So you all may write in the group chat or mute yourselves. I know there's a lot of information they just went over. Don't worry if you felt like you missed some stuff. We're going to send you the recording of today's event, so that way you can reference back. On this next page here, I'll put both the contact information up there. That's Talithia on the left and Lee on the right. They got the phone number, the email address, as well as the websites and fax numbers and direct lines. So any questions for any of them right now? Anybody? No. Okay. So again, we'll be sending out the recordings to you all. However, if you can be so kind as to put your real email address, just like Lisa right there, on the group chat, so we make sure we got the right email address. Also for you guys on the Facebook too. Cool. Thank you, Ethan. Appreciate it. Thank you, Terrence. Thank you. Alrighty. So if nobody has any other questions, this is the contact information. Feel free to reach out to them afterwards. I just want to give a chance right now. Give a round of applause to both ladies. Other than that, appreciate you guys joining in today. You have any questions? The contact information is right there. Lee, thank you. Talithia, thank you. Everybody on the group, thank you for attending. You guys have a good weekend, and let us know if you have any questions, okay? All right.
Thanks, guys. Have a good weekend.
See you soon.